There are two types of stock investors. One buys a stock and prays the price goes up. The other buys a stock and gets paid whether the price moves or not. Only one of them sleeps well at night. Let me ask you something before we go further. If the stock market crashed tomorrow and stayed flat for the next 2 years, would you still make money? For most investors, the honest answer is no. Their entire strategy depends on the price going up. But there's a small group of investors who don't lose sleep over that question because they get paid in cash every quarter, every year, regardless of what the price is doing. That's the world we're stepping into today, dividend investing. Here's a quick way to picture it. Imagine you own a small piece of a farm. You didn't plant the crops, you didn't harvest them, you didn't drive them to market, but because you own a share of that farm, the farmer sends you a portion of the profit every season, automatically without you lifting a finger. That's exactly what a dividend is. You own a piece of a company, and a company sends you a slice of its profit straight into your account just for holding the shares. Today, I'm breaking down exactly how dividends work, the two numbers every beginner confuses, how to tell a reliable dividend stock from a risky one, and a simple automation that quietly compounds your money in the background. By the end of this video, you'll understand dividends better than most people who've been investing for years. Let's get into it. First, the basics. A dividend is a portion of a company's profit paid directly to its shareholders in cash. You don't apply for it, you don't work for it. You just have to own the stock when the payment goes out. Companies pay on different schedules. Some pay once a year, some pay quarterly, meaning 4 times a year, and a few even pay monthly. But here's the catch. Not every company does this. It's usually the larger, more established, already profitable companies. Banks, consumer goods giants, energy companies, fast-growing startups almost never pay dividends because they'd rather pour every dollar back into growth. Let's make this concrete. Say you own shares in a well-known company like Johnson & Johnson. That company pays its shareholders every 3 months like clockwork. The more shares you own, the bigger that payment gets. And checking whether a company pays dividends takes 10 seconds. Search the company name plus dividend, and it shows you the payout and the schedule instantly. Now here's the part that trips up almost every beginner, the difference between dividend amount and dividend yield. Dividend amount is the actual dollar figure a company pays you per share. Say a bank stock pays $2 per share every quarter. If you own 50 shares, you multiply $2 by 50. That's $100 landing in your account every 3 months just for holding the stock. Dividend yield is different. It's not a dollar figure, it's a percentage. It tells you how much a company pays in dividends relative to its current share price, and it's the number that actually tells you whether a stock is a good dividend payer. Because a dollar means something different depending on how much you paid to get it. Here's how you calculate it. Take that $2 per quarter, multiply by 4 to get the annual dividend, $8 a year. Divide that by the share price. Say the stock trades at $160. 8 divided by 160 times 100 gives you a 5% yield. That means if you buy today, you're on track to earn roughly 5% of your investment back every year just from dividends. Here's why yield matters more than the raw dollar figure. Say you buy that stock at $160, and a friend buys the same stock later at $200. You're both getting paid the same $2 per share every quarter, but because you paid less to get in, your yield is higher. You're earning a bigger return for every dollar you invested. Same dividend, different value, depending on your entry price. That's why yield, not the dollar amount, is the number serious investors actually track. If that clicked, drop yield in the comments so I know you're following. Now let's talk about how you actually pick a dividend stock you can trust, because not every company paying a dividend today will still be paying it in 5 years. Step 1. Check the dividend history. Search the company name plus dividend history and look for 2 things: consistency, meaning has the company ever skipped or cut a payment, and growth, meaning has the payment increased steadily over time. A company that keeps raising its dividend, even by small amounts, is telling you it's financially healthy and it values its shareholders enough to keep rewarding them. Step 2. Learn to spot dividend aristocrats and dividend kings. A dividend aristocrat has raised its dividend every single year for at least 25 consecutive years. A dividend king has done it for 50 years or more without a single missed payment or a single stagnant year. Companies like Coca-Cola and Procter & Gamble carry this title. They've kept paying investors through recessions, wars, and market crashes. If you're investing on the Nigerian market, the same logic applies even without the official label. Check the dividend track record of companies like GTCO or Dangote Concrete on the NGX. Consistency and growth are universal signals no matter which exchange you're trading on. So to recap, check the history for consistency and growth and give extra trust to companies with a long, proven track record. Now, the part that actually accelerates your results, a tool called DRIP, short for Dividend Reinvestment Plan. Here's the idea. Instead of your dividend landing in your account as cash, your brokerage automatically uses that money to buy more shares of the same company. No effort, no decisions, it just happens in the background. Why does this matter? Compounding. Every dividend buys you more shares. Those new shares earn their own dividend next quarter. Those dividends buy even more shares. Over years, that creates a snowball that can meaningfully outpace simply pocketing the cash. A few real advantages. It's automatic, so you never have to remember to reinvest manually. Most brokerages charge 0 fees for it, so every cent of your dividend goes to work. It supports fractional shares, so even a small payment still buys you a partial share instead of sitting idle, and it's genuinely satisfying to watch. Every dividend notification means your position quietly got a little bigger without you doing anything. Setting it up is usually a single toggle in your brokerage app's settings. Look for Dividend Reinvestment or DRIP and switch it on. If you can't find it, your brokerage's support team can point you to it in under a minute. If dividends are new territory for you, start small. Pick 1 or 2 companies with a strong, consistent history, understand their yield, and turn on reinvestment. That's the whole game. It's not flashy, but it's one of the most dependable ways to build long-term wealth, money that shows up whether the market is having a good year or a terrible one. If this helped, let me know in the comments what you want covered next in this beginner series. And if you're ready to go deeper, check the next video where we break down how to build a starter portfolio from scratch. See you in the next one.